Hey, what's up, guys? So today I'm here to talk about and run through a discounted free cash flow model. So today what we'll be doing is we'll be going over the template that I use personally, how it works, what the variables are that you need to plug into it, and we'll do a little mock run through with some fake numbers to show you guys how it actually calculates and comes up with an intrinsic value for a business. So just as a disclaimer, I have to say I'm not a financial advisor. This is not financial advice. Quite honestly, I'm a nobody. I'm nobody important in the space whatsoever. I'm just a personal investor who's been doing this for some time. And the reason I'm making these videos and I'm going to start this channel is because I think it's really important for new investors to have the proper information um, and some proper skills in order to be as successful as possible in the space. So, with that being said, what is a discounted free cash flow model? Well, a discounted free cash flow model is simply just a financial tool that allows you to plug in a few variables and some historical cash flows with some estimated future cash flows, and it combines them and discounts them by a specific value called the weighted average cost of capital to give you what a business is worth today. And the beautiful thing about a discounted free cash flow model is that what it does is it takes all these variables and all these numbers and it basically spits out one important number for you, and that is what is the business worth today? And it conveniently does that for you on a per share basis. So the final value you'll see today is literally the intrinsic value per share of this fake company. And what it does is it tells you what should you be paying as a fair price per share for a company for X future growth, right? And I mean, that's a pretty powerful tool because, as Warren Buffett says, stocks are not gambling chips. They're equity pieces in a business and they should be treated as such. And investment is most intelligent when it is most businesslike. Thank you, Benjamin Graham. So, with that being said, I think it's an important tool for a lot of new investors to have. It's a skill that you should definitely develop. You should be able to take financials and be able to derive a conclusion about what the fair value of a company is. It's just a necessary skill in the investment world. And I want to deliver to you guys for free, for fun, just because I think it's important. So, without any further ado, let's go ahead and jump in.
Okay, so this is the template that I like to use for the discounted free cash flow model. The reason why I like to use this one is because I find it pretty simple to understand. So on the left-hand side here, you have all of your market variables and assumptions. So these are all the variables you're going to use in your calculation. And on the right-hand side, you have the actual valuation model where you plug in your estimated future growth rate and you come up with your intrinsic value per share. So just to kick it off, let's do the risk-free rate. So the risk-free rate is simply a rate of return that you can get in the market with pretty much little to no risk. So in this case, I like to use the 10-year US Treasury, and that's currently sitting at 3.516 the last time I checked. And the reason why I like to use the 10-year US Treasury is because I like to look at my companies and my investment time horizon with a 10-year window. And the reason why I don't like to use anything beyond 10 years is because it's pretty much impossible to predict what a company is going to look like 20 or 30 years from now. So any values you come up with are most likely wrong. Next up, we have the market risk premium. So the market risk premium is simply just the difference between a standardized market return and the risk-free rate. So in this case, I'm going to use a standardized return of 8%. And if I subtract 3.52%, I'm going to come up with 4.48%. And so the market risk premium is exactly as it sounds. It's the risk premium you get on top of the risk-free rate for investing in a riskier asset class such as equities. Next up, under the equity assumptions, we have the beta. So the beta of a company is simply just a proportional, it's a unitless value that indicates how a company moves in relation to the stock market as a whole, based on price. So if you have a beta of 1, that means the company moves in exact proportion with the stock market. If you have it less than 1, it means it moves less than the stock market. And if it's above 1, then you have a company that moves more than the stock market. So once we plug that in, you can see that we've come up with a cost of equity calculation. And that cost of equity is 8.67%. So what the cost of equity is it's basically the rate of return that a company will pay you for investing in their company. Or in other words, it's the minimum rate of return on equity that a company needs to achieve to satisfy its shareholders. Or in yet other words, it's the risk premium that a company pays investors for investing capital into their company. So next up, we have the market value of equity, and that's simply just the market cap. So let's say it's a $50 billion company. And keep in mind, guys, throughout this whole model, my units are based in the millions. So when I write 50,000, it's actually multiplied by a million, which means 50 billion. Next up, under the debt assumptions, we have our pre-tax cost of debt. So this is simply just the interest rate that a company would pay on a loan. So just like individuals, companies sometimes take loans from banks or other companies, and we can assume a fair interest rate would be about 5%. Then we have the effective tax rate, which is just the standard corporate tax rate, which I believe is about 20%. Then we've calculated our after-tax cost of debt, and we get down to the market value of debt. So for this value, I like to use total debt. Some people might use net debt, some people might use current liabilities or total liabilities, but I just like to use the total debt value, and that can be found on TradingView financials pretty easily. So let's say it's at 2 billion. So we get a firm value, which is simply just the market cap plus the debt. We get a debt to market value ratio, and we get the all-important weighted average cost of capital. Now, this is arguably the most important variable in the model because it's what you're going to discount your future cash flows by to come up with your present value. Then we come up with our initial cash flow. So for this, I just like to use the most recent full fiscal year's ending cash flow. So in this case, it's 2.1 billion. And then we get to the long-term growth rate, otherwise known as the terminal growth rate. And that value always matches what the estimated growth rate for the GDP will be. So let's put that at 3%. And you can see that I have pre-populated some cash flows here. Keep in mind, guys, that this is just totally made up. This doesn't reflect any actual company. And then I've got each year's growth rate. And I've spit out an average growth rate for the last 6 years. So as you can see, this growth rate sits at 19.53%, which is pretty good, I have to say. Like, if this was a real company, that would get me excited. Now it's time to plug in our estimated future growth rate. Now, when it comes to this, I like to produce a really conservative future estimated growth rate. And the reason why I like to do that is because I want to calculate a really conservative intrinsic value per share. Now you might be wondering why I want to do that. The reason why I want to do that is because I'd rather produce a conservative value, see where the company is actually trading at in the market, and then see if they line up at all. And the reason why I want a conservative value is because I'd rather underestimate a company's future performance and then watch it outperform than overestimate a company's future performance and watch it underperform. So I produce a really conservative value because if it outpaces that conservative value, well, good. If it doesn't, good. So if we got an average growth rate for the last 6 years of 19%, then I'm going to go with a conservative guess of 14% for the next 6 years. So you can see that our free cash flows have populated and they grow at a compounded rate of 14%. And then we end up with a total firm value. So basically what this is saying is that assuming a 14% future growth rate, by 2027, the company is going to be worth $91 billion. But I don't care what it's worth in 2027. I want to know what it's worth to pay today for a company that's going to be worth $91 billion in 2027. So that's where the present value column comes in. Now, all we do is we take these cash flows here and we divide them by the weighted average cost of capital to come up with these values here. And we get our firm value. So basically what that's saying is that a company that's worth $91 billion in 2027, discounted by 8.49%, is actually only worth $68 billion today. So then we subtract our debt value from the company and we come up with an equity value for the company of $66 billion. Now the last variable to plug in is the amount of common shares outstanding. So in this case, let's say the company has 891 million outstanding common shares. So assuming the company has 891 million outstanding common shares, we get an intrinsic value per share of $74.18. So here's where I'll show you why this little margin of safety is really, really handy. So say you go into the market and you notice that the company is trading at $81 per share. You're like, oh shit, well, it's trading above my calculated intrinsic value. But keep in mind, you've calculated a really conservative intrinsic value per share. So assuming you were to go into your future growth rate and plug in what the historical average growth rate was, right? So assuming the company does exactly the same thing for the next 6 years that it has been doing for the last 6 years, and it achieves another 19% growth rate over the course of that time, well, you see that the actual intrinsic value for the company is $94 per share. But if you come in at $81 per share, right, and you notice that the percent difference is negative 15%. So you've automatically just created for yourself a 15% margin of safety from the actual intrinsic value of the company. And to me, that's always a good thing. Margin of safety is key. All right, so that was the run through of the discounted free cash flow model that I use personally. I hope you guys found it super easy and straightforward to use. Like you saw, it wasn't overly complicated, but if anybody is left at the end of this video still with some questions or whatnot, please feel free to post them in the comments, message me privately on YouTube. You can follow me on Insta at DylanThomasV. Just to reach out to me and ask questions as well. And if you really, really wanted to, what we could do is we could set up a Zoom call and I could walk you through what I know and hopefully I can answer your questions for you. So with that being said, I will be posting more videos, things like how to invest like Warren Buffett, hot stocks, tips, tricks to avoid, all the things that I've learned over the last 10 years of jumping into the investment world. So please click like and subscribe, and I will see you guys next time. Thanks for watching.